1st. Today's session will be recorded. If you have any audio or video problems, or if you want to rewatch today's session, all recordings and registrations are available on rlpnetwork.com under the training tab. During the webinar, if you have a question for Phil or Beata, please use the Q&A feature. The Q&A icon is at the bottom of your desktop screen or in the 3-dot menu at the bottom right of your mobile device. Please note, Q&A is the only source we take questions from. Next to the Q&A icon, you will see the chat icon. Please use the chat feature to share any comments or observations with your colleagues and ensure your chat response is set to all attendees so we all have a chance to see what you are sharing. Let's try that now. Use the chat and share where you are joining us from across this beautiful and nearly 153-year-old country of ours. Hey. Good day all from Phil. All right, thank you. Good day, Phil. Collingwood, Mississauga, Sarnia. Okay, lots of Ontario, like we always see. Let's get, Quebec, yay. How about West Coast or East Coast? Vaughan, Kitchener, Moncton, New Brunswick, yay. Okay, good stuff. As always, we have President and Chief Economist, TD Bank Group. Beata joined TD in 2003, where she leads an agile team of economists tasked with delivering economic content on Canadian and US stress test. Folks joining us from different parts of the country. Welcome everyone, wonderful to have you here. Thank you for attending today. It is my pleasure to introduce you to our guest, Beata Caranci, Senior Vice President, Regulatory Requirements, as well as baseline forecasts and research publications for TD clients. Beata's team delivers a wide scope of research covering Canadian, US, and global economies. A member of the C.D. Howe Institute's Monetary Policy Council, Beata is also a member of the Economic Council at the American Bankers Association, which she herself will chair in 2021, meeting with the chair at the Federal Reserve twice annually to discuss economic and policy views. Beata has dedicated more than a decade to researching and driving awareness amendments on disclosure of women on boards and in senior management. A separate report deconstructed the educational system and workplace environment for women in STEM fields, including an invitation to appear at the Senate Open Caucus to discuss policy prescriptions to counter systemic biases. Beata's distinguished evidence-based research, combined with the breadth of her role as Chief Economist for TD Bank, earned her the Professional Category Award for WXN's 2019 Canada's Most Powerful Women. It is our extreme honor to welcome Beata here today to discuss her perspective on Canada's economic and housing market recovery and our road ahead, together with our fearless leader, Phil Soper. Phil, please take it away.
Thank you, Kelly, and thank you so much, Beata, for joining us. The relationship between Royal LePage and TD, and in fact, the entire Brookfield company and TD has been so strong for so long. Great Canadian institutions. It is a great pleasure and honor to have you online with our team coast to coast today.
Oh, it's my pleasure, and it's an honor as well for me. So thank you for everybody. I know we're in such busy times with the adjustment that we're all making. So just the fact that people carve out this point in their day ahead of a weekend, or at least a Canada Day break, is meaningful. So truly express gratitude for taking your time to share as well.
Well, thank you for that. Listen, I'm going to start with your focus on women in business. My eldest daughter, who has a degree in international business, got a job with an outfit called Let's Talk Science, which is tries to promote women in STEM fields, science, technology, engineering, and math. And I find it, I've got 4 kids and they're all girls. So had this passion about women in business, women in STEM fields, and that sort of thing. We've got 1 engineer in training. When you spoke at our national conference in Halifax a few years ago, one of the pieces of information you shared, which my team will tell you I latched onto, and I've been a huge proponent of it as a difference between us and other parts of the world, most notably the United States, was the employment rate as it related to participation of women in the Canadian economy. When did you first catch on to the importance, and maybe you could explain to our viewers what it is I'm talking about and why it's so important?
Yeah, it's the reference that when you look at where you can get your drivers to your job market, which ultimately propel your economy forward, there's only really two drivers. You can engage from within, meaning, have more of your existing population participate in the labor force, or you can engage outside, and that would come through our immigration policy. And Canada has both of these drivers, which are very strong. And it is one of the key differentiators between Canada and the US. I think we think of ourselves so similar in terms of, capital markets, democracies, very similar outcomes in terms of wealth, and while our healthcare systems are different, how we pay, ultimately we think culturally there's a lot of big similarities there. And because we're neighbors, we probably more associate with the US than we would with Europe, for example. But when it comes to this, in terms of labor force, women participate in the labor force significantly greater in Canada than they do in the US. And so they're not really engaging all their drivers. So they've also blocked immigration recently, as you know, and they have much lower rates of female participation rates. And so as great as that country is in so many areas of capitalism, this is one area where they stumble. And it happens to be where Canada is a really good international example. Now, the reason we get higher, go ahead.
Well, I was just going to say the metaphor I used was two hockey teams. You got 15 people on each team, and we suit 12 and they suit 8. So
yeah,
we get more out of the same population.
We do. And then the fact that you have your daughters in STEM tells me I should have been interviewing you when I was researching those papers, because
passion, if not no experience-based research.
No, it's a rare thing, and it speaks to a lot of the household influences, the parental figures, what they're exposed to, because a lot of that research is showing that when you compare in school, grade school, high school, girls versus boys, it's not an academic difference. And in fact, girls were scoring higher in standardized math tests. It's a confidence issue, and it's a role model issue. And so when you have a household and you say, oh, I have a daughter in STEM, it is quite anomalous if you yourself are not working in that field in particular.
Yeah. And you know what, for the housing industry, the other thing I share with our team is housing is expensive in our biggest cities, in particular, major markets. And when you have two professionals, two working people in a family, the likelihood that they will purchase real estate and continue to move up in the ladder of real estate purchases is so much higher. So we're providing housing to people at a greater extent, I think, probably in the United States, greater quality, greater expense, and greater frequency, perhaps.
Absolutely. So we do have higher home ownership rates across every age cohort. If you do a comparison of millennials, which is, you're sitting, basically your mid-30s on average, that compared to American millennials, there's like a massive gap. I think it's about 8 or 9 percentage point differential in home ownership rate. Very large.
I did not know that.
Yeah, and so what happens is a lot of our American counterparts say, well, we guys have so much debt. How do you afford your homes? Because everybody thinks of Canada. You've seen those IMF graphs where they put the debt to income ratios in it. They are elevated. There's absolutely no doubt. However, what I remind them is when you break that down into cohorts, ages, American millennials are as debted as Canadian millennials. There's like very little separating them. The difference is Canadian millennials save via their house, so their debt is related to mortgage debt. Americans have much less mortgage debt, but they also have much higher student and other debt. And that blocks them from getting into the housing market. So they have a much bigger barrier of entry than what you'd see in Canada.
Isn't this fascinating? So here's a policy choice made as a nation, and Canada follows the path of at least Northern European countries in this regard, where we view education as a right, healthcare as a right, and we're seeing it translate into the housing market and in the perhaps, I don't know if there's been any, if we've really proven this even, or if there's any serious hypotheses that are on the way to being proven as it relates to treating COVID-19, but you'd think the fact that we have universal health care would mean that there's a difference in outcomes in Canada versus the US. Although I suppose, we're on such different tracks in the two countries, but it has a lot more to do with policies opening and shutting economies than it does with health systems, I suppose, at this stage.
Yeah, it really depends on your value system. I used to spend a lot of time physically in the US, now it's via this. When they ask about our tax rate and you say, oh, your highest marginal tax rate is 54%, they will fall off their chair, right? Like that is, and that's how we're paying for our universal health care. I saw you have people from New Brunswick here. New Brunswick's got the highest of the nation, so they're even above that. So that's the trade-off. You're making a value-based decision on how you're spending your money and treating your population, and their value-based system is lower marginal tax rates and more of a survival of the fittest type, as opposed to what they would consider us to be very socialist country. Even the way, I don't know if we would consider ourselves as left socialism as they might perceive us to be.
No, and you know what, when it comes to, call it left versus right values and things, Canada lines up on a lot of values very similar to US. We're so different in terms of, for example, our attitude towards guns than the United States, yet it is farther along towards the United States approach to gun ownership than any European country. So, the number of guns per capita in Canada is way higher than you'd find in Europe or the UK, yet way lower in the United States. So we are pulled culturally towards America. Yeah. Yeah,
to me, I find the easiest way to think of it is if you think about like constitutional language between the two countries. The US has, life, liberty, and the pursuit of happiness. And in Canada, it's peace and good governance. That really defines how you set up your taxation system, where you put your emphasis and values. And you can see the life, liberty, and happiness works extremely well for the US. They are the most powerful nation. Still, they have better growth outcomes than what you're seeing in Canada. But on the flip side, you have to buy into the value system that underlies it.
Why don't we step back just for a second? Give us a feeling for how COVID-19 impacted the world, maybe even a little step before that, because we came in to 2020 after a correction in the housing market where our audience was. But the end of 2019, we worked through B20, the federal stress test, and all markets were pulling ahead. We had 23% year over year volume growth in Alberta in February before the March slowdown. So all our major markets were up year over year. It appeared like things were good. Were they good globally too? Was the world on a good footing coming into the crisis? And how has the world responded economically differently, say, than in Canada?
I would say so. If you almost have to, it seems like such a distant memory. But we got reminded of it last, we got reminded of it last week. Remember, the trade tensions were the area that were the point of contention, China in particular, but US had also pivoted we already had pivoted to Canada. Then they went to China, and then they were pivoting to Europe with tariffs. So from that perspective, from a sense of global trade and globalism, that was certainly feeling like it was under threat. And today it feels even more so, like it's been magnified given the environment. But in terms of job markets in Europe, North America, Asia, we were looking at pretty tight job markets or tightening job markets, depending where you were. It was very tight in Canada and the US.
In other words,
and in Europe,
very good job, not good for if you're looking for employees, but very low unemployment.
Yeah, and good momentum, good resilience that was coming through. Europe's usually a laggard to the growth of what you see in North America, but even they were holding in with a fair bit of consistency. So we were in a good spot, with the exception of the anxiety on the trade front that was undermining business investment. Yeah.
And was there trade friction outside of the Trump administration?
Not necessarily, I think. First of all, the U.S. in their defense does have very valid points about the WTO and how they do remediation of issues being an outdated structure, needing to step more into the times, especially with digital economy and China's much bigger footprint globally from 2001 when they entered the WTO and had more of an emerging market status versus now being the second largest economy in the world.
Right.
So I think he had, there were some valid points there, and they could have easily have gotten, I think, Europe and others behind them on those points, but they chose the tactic that they chose in terms of doing a more one-on-one confrontation with the country. And, that's a legacy that we will continue to live in. Having said that, the reforms are needed in a number of international bodies, and although we may not agree with the tactic the U.S. is currently following, it may, in the end, as painful as it is now, kind of galvanize these institutions to modernize as they go forward, and that could be a net benefit. But unfortunately, that's not something that's in the immediate future.
Yeah, and gosh, with people closing borders, I read this morning about a man who sailed single-handedly from Portugal to Argentina because Argentina had closed all their borders and he needed to get back to his family. So an 84-day sailing trip across the Atlantic. Some people take it a little bit more extreme than others.
Did they let him in?
Oh yeah, I guess you could arrive by boat. It's sort of like the weird Canada-U.S. border thing. You can fly to the U.S. as a Canadian, but a Canadian or American can't fly to Canada, and you can't drive across. But
can't drive.
Yeah. So as we look around the world, are there any models that stand out to you in terms of managing the economic recession that has been triggered by this health crisis?
Well, I would say Europe is actually proving to be a very good model. We'll see where they end up in about 4 to 8 weeks. So they, like where the U.S. and some of the states in the U.S., they are feeling pressure to reopen their borders because countries like Italy, huge reliance on tourism, and they also have a high interdependency on each other, even for allowing the flow of the population. So the big question is whether, this goes to the lives versus livelihood debate that we keep talking about, that, in a perfect situation, you can keep your borders closed, but that does not allow for the building of nationhood in places like Canada and the US, or of the EU sentiment across those countries, right? So there's a bigger picture that you have to keep in mind. So they did a tremendous job in bending those COVID curves. Yes. Countries with very low death rates are impressive. When you look at Norway, you look at Germany, there's a number of really good modeled countries out there from a policy perspective. And then what they did well on their job market is Europe, unlike Canada and the US, they are quite accustomed to doing wage subsidy programs. And in fact, when we were in the global financial crisis, that is their go-to program when you have like a big shock that hits. Whereas in Canada, it was brand new. We didn't start off on the right footing. At first, it was like, oh, we'll pay for 10% of your wages. And we said, well, that's not going to help us. And then it finally got ramped up, right? So it was a bit of trial and error. And it has very low uptake right now because the third program came first and it's dominating outcomes. So what Europe did well is they had a very clear vision right off the get-go, go right to the wage subsidy programs, no limitations in terms of qualifications of firms, higher limits on what you can qualify for, more extended period. And I think that's helped keep the income supports under people. And you haven't seen their unemployment rate spike like you have in Canada because they still have greater attachment to the workforce.
So this is fascinating. The economic crisis, the Great Recession, was a decade ago now. It was much harder in Europe than it was harder on European economies and Europeans than it was on Canada. Did they learn from that? And did we learn anything from the Great Recession, from the economic crisis?
I think the challenge in Europe is the same challenge they're facing today, and it's gotten magnified by the pandemic. They have a currency union, they have a trade union, they don't have a fiscal union, a government union. And that always comes to head when you're in a recession. And so when you have the financial crisis, you had, even prior to that, you had Greece that became, in effect, insolvent, and they had to do a bailout there. And you had a lot of countries saying, well, wait a minute, they misused their funds, and now we got to use our good taxpayer dollars to bail them out. So this is a fundamental thing. Like, we face it even in a federated economy, Alberta versus, the federal government and how their tax dollars. So now imagine that across 24 countries happening. And that's their fundamental challenge then as it is now. What the pandemic has done, it has galvanized a bit more of these countries to see themselves as under one umbrella and to be a bit more supportive. There's always outliers like the Northern European countries, which are very much more disciplined in terms of maintaining fiscal balance sheets that are not overrun with debt, who have a little bit of a sticky point about continuing to bail out Italy and Spain and others. So there is a few outliers, but considering how many countries it is, it's maybe 4 countries that are pushing against a bit more of a fiscal union. So it's in an odd twist. The pandemic has actually done what the global financial crisis couldn't do, which was create the fiscal union that they so desperately need in order to run as an actual cohesive economic union. So it's a little bit of a, unintended consequence, but maybe on the positive side for them.
Isn't that interesting?
I know.
So we're talking about the world, and you mentioned in some of your introductory statements how different America under Trump had been approaching immigration. And I believe before the crisis, we were, in terms of the rate of growth, we had grown to what, triple American growth? Yeah.
Population growth, yeah.
Population growth, right. Yeah. And of course, that's been dramatically impacted by the pandemic. What do you think and by extension, in our research, new Canadians, call it people who have been here 3 to 10 years, were hugely important in the Canada's residential real estate markets. How do you think the pandemic will impact immigration in the near term and the longer term, and the economy and the housing market? I know it's a big question, but it's one I've been really pondering myself.
It's a big question, Phil, and it's probably the most important question that we could be asking ourselves, because when we think again of differentiating ourselves from the U.S., because they don't have a strong immigration push, and under this administration, it's continued to slow down. So they used to let in, 1 million to 1.5 million people a year, which sounds really large, but as a share of their economy, it was very small. That number continued to be whittled down. That means all their growth, because they have aging demographics, all their push in their growth is coming through these productivity trends that you're seeing. So the output per worker within their existing workforce. Canada was on the opposite end of the spectrum. We don't have strong productivity growth, in part because of the nature of our industries. We don't have a defense industry like the U.S. We don't have a private healthcare industry like the U.S. These are high productivity, in terms of innovation. We don't have the IT sector that they have in the U.S. either. So they have these big drivers of innovations that come from these industries that we just don't have. The energy sector is a big one for us, and what's happening there. So we do have a lot of eggs in the basket of the, immigrants coming in to propel our population. And immigration accounts for 80% of our population growth. So it's fundamental to how we drive our economy forward. Unfortunately, in the pandemic, we've seen entry into Canada effectively drive itself down to zero for good reasons,
Right.
because border closures, even the government's not able to process applications and things because they were going through their own adjustment. Big changes in non-permanent residences, both on the worker side, but also on the student visa side. So we've had
Right.
this complete collapse. And now the question is where to from here? Do we get this resumption of growth? Well, it's hard to imagine in any meaningful way we're going to get back to where we were, at least this year. So what we had to do within our own forecast is cut our projections for the population basically in half. So think of it as like we came down hard at the bottom of the U and then a very slow climb back up, because there's going to be an element of maybe you still want to come into Canada. We do believe that Canada is still going to look extremely attractive to many people, but you're also facing higher unemployment. So the prospect of getting a job is going to be harder. Universities are accommodating students by allowing them to do portions of their degree online, so they don't physically need to be here and renting and doing other things. So this effect may last well into next year before we get this resolved, hopefully with a vaccine or really good treatments. So for us, it suggests that the household formation in Canada is going to go through quite a big adjustment between now and, let's say, next year, so a 12-month period. And then the hope is that the dynamics just kick in spades. They come back really strongly again. But that obviously has a link into the job market. So if our job market doesn't come back strongly, it's going to be harder to attract new immigrants
and to
into the country.
justify, I guess, right?
Yeah.
Because one of the big policy, well, I think conference board's been a big, and I know you're on their main policy board, and that it's been a big proponent of a strong immigration drive for the health of the economy. And I think even in terms of organic growth, we're not bad as like an OECD country, are we? We're
better
kind
than
of
Europe.
middle, yeah. So we
Low
don't
bar,
do
though,
badly
low
in
bar.
terms. All you women out there having babies, you're not doing bad, not quite enough. But but immigration, as you said, was a key driver. I can't help but think that brand Canada, because we often, if you're looking at, maybe use a product metaphor, and you're thinking about you're a professional, or you're a capitalist, you have capital, and you're thinking about relocating for your family's health and well-being, for a better future. You may look at Europe, or you may look at North America, or maybe you look at the Americas. I'd say in the Western Hemisphere, and the Americas in particular, brand Canada just continues to rise, including the way we've treated people during the pandemic. So you'd think we'd have lots of opportunity. The question is, can we produce the jobs that do immigrants need jobs to come to, or do they produce their own jobs when they come to, or is it a balance of both?
Immigrants get credit for a lot of entrepreneurial activity, so more so than when you're Canadian born. So to your point, do they create jobs? Yes. They do show more entrepreneurial spirit than what is typically a Canadian born individual. So that's the first. However, the entry, if you're trying to enter as a skilled laborer or under the merit-based system, having a job to come to gives you the points to enter the country. And so you can enter through family association. There's a lot of different ways, but that is a critical portion of our immigration policy. In fact, the U.S. wants to mimic it because it's been so successful that we're able to identify labor market gaps and bring people in accordingly. I would say this, that when you look at the pandemic and the job market that we have not seen significant job losses at the higher skilled level for obvious reasons, that the push to the digital economy has actually created more demand for STEM-related jobs. And so you're seeing pretty consistent job demand for certain segments of jobs. And so if you're very high skilled, there's probably really good opportunity for us to continue to attract those folks irrespective. That was actually the criticism that I'm sure you read about with the U.S. clamping down on their H-1B visas. right? And then, comments saying, well, this is a win for Canada because we're all working remotely anyway. So why don't you have them work out of their Canadian counterpart offices and
right? And for those on the line, the type of visa that the U.S. administration just eliminated was the favored way for tech companies to bring programmers, engineers from around the world into work in the United States. And there was a huge uproar from tech companies in California and elsewhere. No, it's sort of cutting off your nose in spite of your face sometimes. Policymakers I shake my head, particularly, I guess, during an election year in the United States when things are so political. Some decisions will be made that make no economic sense, but they may make emotional or political sense. What about interest rates? We've seen I guess, what do you call it? The support rate. We're essentially at zero, aren't we? Interest rates in the Bank
policy
of Canada.
rate,
yeah, the policy rate. So how long do you think we'll stay with interest rates essentially, not mortgage rates? They're call those at 2%, which is still insanely low.
I know.
But is this a sustained thing or is this a short-term thing?
No, I don't think it's short-term in the sense that it's going to reverse out in the next few months. In fact, we could be looking at a policy rate where it is right till 2022, 2023. Wow. So quite a long period. I know. And this is going to materially depend on this labor market in terms of how fast these jobs can come in and what's the degree of structural loss that we've incurred, because there will be some jobs that there's just not going to be an employer there for them. And so this is why the policy rate is likely going to be the least, like the last one that they adjust. Because remember, they're doing quantitative easing. So they're doing asset purchases. So when you think of the timing of what a central bank does, and we can take our cue from the Federal Reserve, because they did this during the global financial crisis. So we almost have a blueprint of, the ordering of events. We know the first thing you do is you cease your asset purchases. So you're accumulating your balance sheet. So you start to say, okay, we don't think we need to continue to accumulate because the economy has a good footing. The risk atmosphere has receded. So they stop the accumulation. That stopping of the accumulation leads to a rise in your longer term yields. So just because the policy rate's not moving doesn't mean the yield curve would not steepen. You'll likely see some steepening. So mortgages that get priced on the longer end might see some movement at that point. But it's related to the fact that market expectations are adjusting, that we're no longer in the perfect easing phase, and we're moving more into a balanced phase. After that, they usually wait 6 months to a year before they adjust the policy rate because they want the market expectations to kind of settle. And so if they don't like what they're seeing, meaning let's say the 5 through 10s have popped way too strongly, markets have overpriced, what they could then do is called yield curve targeting. So instead of buying a bunch of different assets like now, they could say we're only going to focus on sovereign yields in the 5, 7, and 10 because we want to just lower that portion of the curve. We think it's gotten a little ahead of itself. And that's a very strong signal to the markets to say, okay, let's all back off our expectations. So they have still control, right? They can stop their broad asset purchases and start to be a bit more surgical about how they do it. But in any event, when you get to that phase, the signal to the market is the economy is in better footing and we think we can start to roll back. About a year after that is when they start to do the policy rate. So now you go from a yield curve steepening dynamic to a level shift up, right? Because now the short end starts to come up as well. So there's stages. So your first clue is follow what they say on quantitative easing. That's going to be your first clue on the timing of everything else.
And quantitative easing, for those on the line, would be a way that central banks like the Bank of Canada or the Federal Reserve continue to keep capital flowing so businesses and even homeowners can continue to buy mortgages and the economy the wheels of the economy keep moving around. And it's been I know everybody focuses on the target rate and interest rates and therefore mortgage rates, particularly in our business. But the lessons they learned in the financial crisis that they're applying again here are that keeping those wheels of the economy moving are incredibly important right down to the consumer level, aren't they?
Yeah, so it's not just like, so to your point, what they're doing is trying to create liquidity in the market, right? So they're being the demand source for these products. You can continue to issue mortgage-backed securities, corporate bonds, and others. Like they're literally buying corporate bonds. So that's one purpose. But the other purpose is in doing that, the physical action of doing these purchases is lowering the risk premium. So the cost of the funding to these companies, to these individuals. And so it lowers the spread between the sovereign yield, the bond yield of the government Canada bond that everything is priced off of, including mortgages. So that drops down, but it's also lowering all the comparables. So it keeps you from getting into a situation where, you know, maybe your government bond is 1%. However, your, triple B bond for a company, they're priced at 6%. And that would be what you're saying. All of a sudden, the wheels start to come off the economy because they can't issue. It's very expensive.
Right.
It may force companies into illiquid positions. So that's what they're trying to stop.
So central banks, policymakers, monetary policymakers, as it relates to the, getting really close to home, the Canadian housing industry, want not only people to be able to people to qualify to be able to acquire a mortgage, but they want the price at which they acquire that mortgage to be at a rate where it encourages people to trade, and therefore they spend and the economy kind of chugs along, which is a good story, I guess, if people have jobs and they can qualify. Let's talk really briefly about the bank's decision. I guess it must have been in concert with the Department of Finance, the Ministry of Finance at the federal level, to put the mortgage deferral program in place. That happened very early in the pandemic crisis, did it not?
Very early, yeah. It was kind of, the writing was on the wall when you
saw what was happening in Europe.
Well, and you shut down the economy. This is not a matter of, we have a company that has a poor business model and needs to go bankrupt. This is like we're telling everybody to stop working. It was very clear you were going to have massive income disruption. And at the time, they hadn't fully put through all their income supports. Like the wage subsidy was last. The CERB, they got off the ground really fast. But it was just a very big unknown factor that even with the CERB, if you were low income, you're getting there's a good chance 100% of your income is supported. If you're medium and high income, that's not going to do the trick, right? So it was really obvious right off the bat there's going to be issues here. And so they did work with the banks earlier on to establish those programs. And we were seeing anywhere from 1 month to 6 month deferrals happening. The question is what happens after then? And that's where the job market will tell us.
How many Canadians or what percentage of Canadians with mortgages are taking advantage of the program?
Well, I know for TD, we have about 126,000 customers who have deferred it. I think it's about 13-14% of the loan. So it's quite significant.
It's material.
And our experience wouldn't be that much different from what others are going through as well. So we're trying to accommodate as best we can across the spectrum. And again, we've provisioned, as you would have seen our last earnings. Likewise, we've had to provision for the possibility that some of these folks won't be able to pay for their mortgages at the end of it, even with deferral. So we had about $3 billion in provisions that we set aside, and as did other banks.
So coming into the crisis, our default rate, foreclosure rate, was very, very low. I think it was at a record low of 0.24 of 1% of mortgages outstanding went into default. And I think the previous governor of the Bank of Canada suggested that could go up to 0.8. Now, CMHC took a wildly more dark and grim, I think he's been reading or watching horror movies or something, but it was a really grim outlook of the future. But focusing on the Bank of Canada, would a move from 0.24 to 0.8, could the economy manage that, handle that? Is that something I know it's something that we must be concerned about, but is it at crisis level or manageable level?
So I can tell you for certain the banks can manage that, right? Unlike the global financial crisis, there's a new accounting rule, and the reason we're provisioning so much is you provision ahead of the losses. So they've got like everything kind of like shored up, right? We're not concerned about the financial system, but the reality is if you're at a 0.8, to give you a perspective, that's higher than the global financial crisis in terms of default rates. Yeah. So what that would suggest is that means you must have a fair bit of households in distress for that to happen.
Right.
And that's going to take time to play through. Remember, those households subsequently get their credit ratings affected. That affects their future purchases for years to come. So that's the painful aspect of getting past it. And it is, like I said, when you take it to the experience of the global financial crisis, we would be looking at, similar types of outcomes from that period.
Okay. And Canada bounced back quickly from that.
We did. Yeah.
Yeah. I know the default rate in the United States, even before the crisis, was maybe 10 times higher, 11 times higher than in Canada. I imagine, and you made this point earlier, it triggered, I went, yeah, that makes sense, because it makes sense in the real estate market. They tend to be more aggressive. They take more risks in many aspects of their economy, including writing mortgages. And one of the outcomes is they have way higher defaults, but they probably can build a model around 2.5% default, but it has the potential to go much higher in America during the pandemic than that, I would imagine.
Well, interestingly, the one thing that the global financial crisis did do is it galvanized the regulators to actually follow stress testing exercises, which Canada had already been doing about a decade in advance. So we had a much more disciplined approach to how we checked for the resiliency of the banking industry here. They did not have that in the US. They do now, and they are doing, the American banks are doing very similar to Canada. They're provisioning ahead of the actual stress, because like us, they are also doing mortgage deferrals. We're doing it for our US clients as well. And so they can see a little bit of the writing on the wall that if a percentage of these folks don't get their job back, then we're going to have to make sure that we have provisioned accordingly. So they are much better prepared, I think, this time versus the financial crisis. And the financial crisis was very unique to the banking sector, which this isn't. Right. The problem then, right, it was literally mortgage lending, which was the problem, and very lax standards in qualifying. You remember those, what they call ninja, and no income, no job, and hey, here's $1 million, go take a mortgage. So that behavior does not exist today. So the amount of leverage and risk related to the household in the US is not like it was then. So I actually don't think they're going to see like a tsunami of defaults more so than what we would expect in Canada. Okay,
well, that's good actually, because the elbow joint's connected to the shoulder joint, right? Yeah. We want housing to work well so we can sell them lumber and petrochemicals. So and all sorts of other good stuff. Our smart.
It might give you some comfort to know that because they have very low home ownership rates, and there's a legacy factor with the global financial crisis, there's a sense that they're millennials like ours. There's pent up demand. It's kind of bubbling up. And so what we have seen in the US is mortgage applications, which they produce on a weekly basis, had reached an 11-year high 2 weeks ago.
Wow, so, that's really encouraging.
And this wasn't for refinancing, it was for purchases. So there was this resurgence in applications. And then last week it declined, it broke that like positive trend, but still on a year-over-year basis. There are more applications to buy homes today in the US than there were a year ago. In the middle of the pandemic.
And when we chatted a couple of weeks ago, I gave you some insight into some of our leading indicators. And one of the ones that I've been following we all been following very closely is the number of unique visitors to rollapage.ca, which is the biggest real estate company, real estate portal, listings portal in the country. And they are up over the last 4 years, over last year, same period. And we're getting to the point where we're not comparing to really a nasty year. In the beginning of the year, the beginning of 2019, volumes were down quite a bit because of the correction, the B20 or the mortgage stress test during the collection. But by mid-year 2019, things were coming out of the woods. And we're up 58%. Like, we have not seen that kind of spike in interest ever. So it is, there is a lot of interest in housing right now. I guess the question will be capacity. And I'm just going to pause just for a second, Kelly, and I'll ask our listening audience, if you do have a question for Beata, please put it in the chat, and Kelly will capture it and pass it on. And just one last question from me for now, Beata, and that relates to home prices. We've seen them remain remarkably resilient so far during the crisis. What do you see ahead for home prices? Because obviously stable home prices mean higher confidence and greater stability in our industry overall.
So we are of the view, so we don't have the CMHC view. I think what were their numbers, -9 to,
good.
They did scenario analysis, -9 to -18 or whatever that lower range was. But there will likely be some downward pressure. In part, our view is not based necessarily on any of the changes of the underwriting rules or any of that. It's really this immigration flow. So if the immigration flow does get cut in half over the next 12 months, that will necessarily feed through to our housing demand. And that's just the reality, that we've had so much demand come through from various sources, even in terms of, although immigrants don't necessarily buy a home when they first arrive, it does fuel investor demand for properties that they turn into rentals. So there's that duality happening. And that's what keeps our prices flat. I wouldn't say we've incorporated a lot of drops or anything in that. Like we might see 2-3% drop year-over-year basis. We're not looking for a substantial drop, but we do think that there's going to be some pressure on the downside as we roll forward, because we'll have to see how these immigration numbers flow through and population growth numbers. We do think there's a fair degree of pent-up demand still from population sources. Having said that, Phil, like there is as you know, I'm talking to the experts here, the markets are very different. I think there'll be a very different outcome for the condo market versus the detached market, where we still see quite a bit of demand, especially, I don't want to make this seem, I know folks out in Moncton know what the Toronto market is like. So when I say well-priced homes in the $1 to $1.5 million mark, there still seems to be a lot of demand there versus your 2 million plus, where you start to see it come off.
Right.
The condo market's a very different beast. There's a lot of supply coming in. There's a lot of low square footage units. Those will likely have a different experience than what you would expect to see in other segments of the market.
Okay, well, fascinating and actually really encouraging for everybody on the line. A little bit of stability or give back, a little bit of slippage in home prices, low single digits is not bad for our industry. I was much more concerned about runaway in housing inflation in 2020 than I was about losing a couple of points in home values. Things will continue to trade hands at home, flat home prices. So
and as you know, housing of all the markets, this is a game of confidence. Right? How confident, because people have to put a lot of equity into this. So how confident do people feel regarding their jobs and the economic prospect? I think there's a fair good view that, you know, we could be in for several rough months ahead if we get a second wave in the fall. But the real issue is how sustainable is that when we get to 2021? If we already can get a sense that the U.S. has some pent-up demand, one would argue that Canada should benefit from that when we get into 2021.
Okay. Kelly, do we have curiosity from the multitude from coast to coast that have gotten so well educated over the last few minutes?
Absolutely, we sure do. Maybe some more pinpointed questions on some areas that have been covered. But from Susan Quaglieri, she asked, you know, we talked about pent-up demand with millennials in the U.S. and certainly with immigration and what might happen here. But, you know, what demographic is showing the most confidence to invest in real estate at this time?
Well, we don't have the data yet by age bracket, but I can tell you the group that's lost the least amount of jobs, who should find that they're more confident in their income and wealth, are going to be people 40 and above. So that's the group that's seeing greater stability. The group most impacted with job losses has been the very young, 15 to 24. Then the next group is 25 to 35. So the degree to which, and that's you're 25 to 35, unfortunately, that's the group that does that first step into the home ownership market. So that's the group we're watching in the job market for it to come back, because they could see this as a buying opportunity, but you would only see that if you felt secure in your job.
And I guess that is the real key there, isn't it? Some of them, and some of our early indications is it's a hard step up in terms of interest in that, call it first-time home buyer. And because they see a window, maybe once in a generation, they may think once in a lifetime, but they just haven't lived long enough. So they want to get in. The question is, do they have the financial means and that sort of thing? Or I know the private mortgage insurers have said they weren't going to follow the internal underwriting policies of CMHC and walk away from a significant portion of those first-time home buyers. Have the banks changed their underwriting policies, or what do you do in a crisis like this in terms of managing the risk of first-time home buyers in particular?
It's a good question. I say that one I don't have the answer to, Phil, because I don't work on that underwriting side. But I would say that for TD, like we always try to follow just good practices on lending. And so to your point, while CMHC has changed underwriting, Genworth and others on the private side have not. So if we feel someone's a good credit risk, it's just a matter of how you want to fund that mortgage by private or public.
Point. And if it is insured, it's insured, and the risk moves to the insured. Yeah, so that makes sense. Kelly? Oh, I think you're still muted there, Kel.
Sorry.
Oh, Kelly.
We have a question from Johan Gawis. I'm sorry I've pronounced that incorrectly, but he was wondering how the real estate market is going to be influenced if more than 100,000 snowbirds don't go to the US this coming winter. What happens to our economy then?
Well, the economy is different from the housing market.
We like to think of it as the same thing. But yeah.
Well, because if you're going to the U.S., if you're a snowbird, it's not like you're selling your property here. You're just kind of temporarily vacating it. And there is no comparable weather in Canada to what you are experiencing in the U.S. So it's not like you would substitute your vacation home in Florida for one. I don't even want to pick a province. It's not going to look good no matter what I say. So for anywhere else in the country. So we're not a substitute for a snowbird. For the economy, which is separate from that question, is really, if you're not going there, then you have to stay home and spend. The challenge for the snowbird view is that these are the elderly population, and they're the most impacted by COVID in terms of illness and death. So this is probably a group that's not right now engaged in the spending cycle anyway. They're going to be much more conservative. You roll in the winter when the flu season's at a peak, when their risk of health is augmented. I don't think it's going to be like a spending boom in Canada because they're not traveling to the US. They're not traveling there because of health concerns. And that's going to overwhelm anything you see in terms of a multiplier effect in the economy. So
it's neutral to maybe a little bit positive to have people at home spending, but it's not going to be material. They're going to have to buy their groceries and whatnot, but it's not like they're going to be at restaurants or anything. That's probably less likely. We have seen, interestingly enough, an uptick in the volume of both transactions and interest in recreational property. Yeah. And lots of theories. People having been told by their boss that they can continue working at home for an extended period of time. Maybe they thought they needed a cottage, a chalet, a cabin anyway, and so they've moved ahead that decision, and they're basically working from a lake or a mountainside as opposed to at home. But I think I doubt we'll see a longer term trend that we'll see people fleeing to the mountains or cottage country completely, but it is one of those micro trends that we're going to be watching. Kelly? Certainly if you're in a tower
I was going to say, certainly if you live in a condo tower, so you retired and made the decision to downsize to a tower, you're probably feeling a little less secure right now, and maybe those type of properties make sense for sure.
Great. How will different parts of the country be affected by during the recovery? Are there going to be different provinces who are slower to come out of this and maybe struggle a little bit longer? Are there provinces that are going to take off and catch fire? What do we see happening across the country?
So you could actually already see some differentiation taking place. So the East Coast, there's a group of provinces there that are all coming ahead. They're kind of doing a little bit better than what you're seeing in the rest of the country. Part of that's related to the fact that they didn't have to do maybe as extreme of shutdown for as long a period, and they were able to reopen. The challenge obviously is, like, you know, as PEI has noted, where you are dependent on American tourists for part of your economy, that's going to be a harder nut to crack, because nobody's really comfortable necessarily with allowing the US border to open just yet. But in terms of domestic drivers, we've already seen that region start to show some outperformance relative to the rest of the country, even in the job market. Quebec, which reopened ahead of Ontario, also coming out of the gates just firing in terms of, they accounted for 80% of the job gains last month, 80%, one province. Yeah. So they had shut down their economy in terms of manufacturing and construction, whereas Ontario did not. So when they reopened it, it was just like, you know, the dam broke and you had a lot of jobs kind of flood in at once. Ontario has been a laggard. It's the worst performing job market in the country right now. And that's because of our slower, more deliberate, phased in approach to reopening. In Toronto, we just got started, this past week, right? And so there's a ton of jobs. Toronto, by the way, accounts for about 45% of the jobs in Ontario. So if Toronto's not engaged, you can imagine it's really hard to get a recovery for the rest of the province. And then we've seen in the West, Alberta with the energy sector, that's going to be a hard slog for them. Really, really downtrodden in terms of this is like their third phase on the energy sector, really hard to get their feet under. So there is a lot of differentiation already coming through in the data. We do think Ontario is likely going to be the catch-up. When we get data in the next 1 to 2 months, you're going to start to see much better job numbers coming out of Ontario for the simple fact that it's finally reopening. It does not mean sustainability or strength, right? It just means you're going from complete stop to start, so you just get this initial lift. And so just don't be too encouraged when you see those numbers. They're going to be positive. Just remember, we're unlikely to repeat the large numbers we'll see initially for many more months to come.
Yeah, we had our national conference last week. Usually the folks get together over cocktails. Now they sat alone drinking cocktails with each other at the end of the conference. But one of the things I talked about was the 4 chapters of 2020, the surge in the beginning, the lockdown, the bounce back, and then a settling into the near new normal. So this group has seen pendulum swings, bounce backs in the past, where you overshoot with exuberance, irrational exuberance, and then a settling. And so I know everybody's prepared.
Great.
Beata, you talked about a temporary pause in immigration and its impact on the economy and the housing market. There was a question from David Ronnie in respect to that, asking about what it means for major markets, because obviously, immigrants come to larger cities.
That's a good question. Yeah.
So
that's a really good question. We've been struggling with that too, because clearly Toronto in particular, Vancouver and these 2 cities absorb a significant amount of immigrants, Ottawa increasingly so lately, and Montreal. So if it does not recover as we hope it will, we think it will, but if it doesn't, it would impart disproportionate impacts into these cities. The cities in this pandemic, in my opinion, are going to be facing quite a significant challenge. It's not just the immigration. If you look at where you have a high share of low-income workers that support businesses, the downtown core with restaurant services, conferences, all of that, these jobs will not be coming back, definitely not at 100%, and we're not even certain if it'll hit 50 or 60% this year. We do think there'll be about 1 million people still unemployed at the end of the year. And that million is going to likely distribute itself disproportionately into the cities. So the cities have two compounding factors. We think there'll be like worse employment outcomes for this segment of the economy, and then the immigration side that could take longer to come back. Having said that, and then who knows, we may see an outflow from the cities as well, right? As native Vancouverans and Torontonians decide that they want to live outside the city going forward. So there could be some compounding factors all hitting where you've had density before.
Yeah, fascinating stuff. Let's end on a positive note. You had your outlook on spending and growth, and it was probably lower than we've seen through the recovery phase. I know it was, the Bank of Canada has said, you know, they're pleased we're on a more positive trajectory than their expected curve. Is that true? Are we essentially tracking a little better than anticipated to this stage?
Yeah, so I would say yes, in that I'll give you an example. In the second quarter GDP forecast, we had thought it would be around minus 45%, and now it's maybe minus 36. So
that's 7 points.
Moving in the right direction.
It's all those people that were told to shut down their economies. You know, in Montreal in particular, yeah, we were told to shut down the industry, the real estate industry, in the month of, the latter half of March and through April. We still wrote 1/3 of normal volume of business. How they did that, I don't know. I don't want to know. But so people are very resilient.
That's exactly it, right? Like, so we are actually at the stage where we went through where all the forecasts were getting revised down week after week. You would have been like inundated. We certainly were. And it was becoming a bit annoying at some point. And I think the former governor of the Bank of Canada, Polo's, even made a comment that it almost like feels like it's a race of who could have the worst forecast, right? Because everybody kept adjusting to this horrible data. We're on the other side of it. We're absolutely seeing recovery numbers. Even within our own bank credit data, we can see that people are spending. Our credit levels are about 4% below where they were last year in terms of credit card and debit use, which means it's like pretty good considering, yeah. I know, considering that we're not even fully reopened. People aren't spending in the same way. To your point about recreational properties, people are also spending on recreational items, like recreational cars and pools, and a lot of home renovation activities kicked in, which is good. But we're still seeing that means there's a level of confidence there, right? Otherwise you would not. And so the recovery phase is definitely showing through in the data.
I like that. What a great way to finish this conversation. And I want to, on behalf of Rolla Pagers from Coast to Coast, thank you so much. This has been, educational and interesting as all get out. I found it just a fascinating conversation. Great to have you with us today.
Oh, thank you. And it was fun for me too. It was great talking with you.
Well, good. And a shout out to Pat Gibbon too from TD. Many of you will know him, and Renee, his a partner in crime who's wanted to retire, but it's hard to retire during a crisis. Yeah, just so sorry, Renee. You still got to throw some buckets of water on the fire. Thank you very much, Pat, and to your whole team. I know you're signed on and listening today. We love the TD partnership. It's been so strong and enduring, and we hope it has another quarter century to go and beyond.
I'm sure.
Anyway, take care. Thank you, Kelly, and your team for putting on the show today.
Happy Canada Day, everybody.
Yeah, happy Canada Day, everybody. Have a great holiday.